Could these two overlooked stocks make you more money than you think? These are companies at the forefront of innovation and industry leadership, a leader in high-tech industrial software and a giant in essential manufacturing that keeps the real economy moving. Their innovation is in process, in efficiency, and in delivering indispensable solutions. One plays in bits and models, the other in steel and scale. Both reward patience. If you only watch one video today, make sure you watch this one, all the way till the end. Hit the like button. Let's get 1,000 likes on this one. Share the video, drop your thoughts in the comments, and subscribe so you don't miss the next important financial investing update. Your support helps this reach more investors who want clear, no-nonsense analysis. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Value investing is buying $1 of worth for 70, 60, even 50 cents. We're after strong fundamentals the market hasn't fully priced. Now let's get to the reason you're here. Our first undervalued company is Computer Modeling Group, trading on the Toronto Stock Exchange under the ticker CMG. This isn't a phone app or a game studio, it's specialized industrial software. CMG builds software that models how oil, gas, and water move through underground reservoirs, called reservoir simulation. Before companies spend hundreds of millions on wells, they depend on these models to make smarter, more profitable decisions. Engineers run countless scenarios on a digital twin to optimize drilling and production. Better models drive higher recovery rates, more oil and more gas from the same field. Optimization also reduces footprint, cuts wasted energy, and targets drilling with precision. For major producers, CMG becomes a key tech partner with sticky, long-term relationships. Decades of R&D and trust create a high barrier to entry, a real competitive moat. Now why undervalued? First, remarkably steady revenue. Second, consistently strong profit margins. Third, a significant recurring revenue base, multi-year licenses, maintenance, support. Predictable cash flow is a powerful defensive trait. Fourth, a fortress-like balance sheet, healthy cash, very little to no debt. That enables R&D investment, resilience in downturns, and returns via dividends or buybacks. Fifth, a modest valuation versus high-margin software peers. $1 of earnings at a reasonable price. The discount stems from oil and gas cyclicality. But beneath that is SaaS-like stability. CMG dominates a highly technical niche, which supports pricing power and margins. Computer Modeling Group is with a market valuation of about $522 million. The company delivered earnings per share of 26 cents, trading at a price-to-earnings ratio of 24.35. In 2024, it generated revenue of just over $108 million, with net income coming in at $26.26 million. For value investors, those pillars add up to a compelling investment thesis. Watch recurring revenue growth, major license wins, and R&D intensity to maintain the edge. Also track energy policy shifts and commodity trends that could sway spending. With that foundation, let's quickly frame the risks. Context keeps you sharp and patient. CMG's fortunes are linked to energy producers' capex. Prolonged low prices can slow licenses and renewals. Less cyclical than drillers, but not immune. Software evolves fast. Disruptors or well-funded rivals could nibble at share. CMG must keep investing in R&D. With global revenue, FX and regional instability can affect results. Track recurring revenue, major wins, R&D as % of sales, and management's read on sector spending. For patient investors, the market may be over-discounting cyclicality versus CMG's durable model. Now let's shift gears. From code to cold steel, the physical economy awaits. Our second company is TerraVest Industries. It trades on the Toronto Stock Exchange under the ticker TVK. TerraVest designs, builds, and sells essential equipment and specialized parts for energy, agriculture, and transportation. Think storage and transport tanks, propane and NGL equipment, anhydrous ammonia tanks for fertilizer, trailers, skids, and other fabricated steel products. Customers include propane distributors, ag co-ops, transportation companies, and energy service firms. Demand is driven by the need to store, transport, and process essential commodities. TerraVest owns a collection of niche manufacturing businesses, a holding company of durable industrial assets. A core growth engine is acquisition, often buying solid family-owned shops at reasonable prices. Then they streamline operations, improve efficiency, and integrate, raising profitability. This roll-up strategy, done with discipline, expands product lines and geographies without starting from scratch. Serving essentials like farm inputs and home heating adds baseline stability even through cycles. Unlike CMG's software, TerraVest sells tangible, heavy-duty products, but both prize efficiency and cash flow. They grow methodically, organically, and through bolt-on acquisitions, focused on per-share value. TerraVest Industries stands out as a much larger player with a market cap approaching $3 billion. The company posted earnings per share of $3.89, carrying a higher P/E ratio of 35.53. For 2024, TerraVest reported revenues of $911.8 million and a net income of $63.57 million. Now, why TerraVest looks undervalued right now? Line by line, the thesis adds up. First, strong and consistent free cash flow in a capital-intensive business. Second, disciplined acquisitions. They won't overpay, they wait for the right price. Third, a long history of integrating and improving the companies they buy. Fourth, shares often trade at lower P/E or EV/EBITDA than the broader industrials due to cyclical fears, creating a margin of safety. The market may underappreciate stability in end markets like propane storage for home heating. In essence, essential industries, cash generation, skilled operators, and a discount to intrinsic value. A classic compounder hiding in plain sight. So how do CMG and TerraVest complement, or contrast, inside a portfolio? Both CMG and TerraVest generate steady cash, dominate niches, and look reasonably, if not attractively, priced versus their earnings power. CMG's defense is recurring software revenue. TerraVest's is the essential nature of its products. Together, they diversify across models. Asset-light IP versus asset-heavy manufacturing. Prefer high-margin recurring software with tech risk, or tangible assets and M&A, growth with economic cyclicality? There's no single right answer. Both exhibit durable operations, healthy cash flow, and price-to-value gaps that merit deeper research. CMG faces energy cycles, TerraVest faces industrial cycles and integration execution. Use this as a starting point. Read financials and MD&A, and match to your goals and risk tolerance. Both of these companies highlight very different scales of operation and valuation profiles, but each demonstrates strong performance within its respective market space. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments, no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Which of these two stocks do you find more compelling, and why? Drop your answer in the comments. If you liked this, remember to like, share your thoughts in the comments, and subscribe to the channel. Thanks for watching, and I'll see you in the next one.